Welcome back to the deep dive. Today, we're tearing into a stack of your source material, focusing on a topic that can seem, well, complex, but is absolutely fundamental to understanding market movement, order flow theory in day trading. This isn't about immediately handing you a specific tool and saying, use this, but rather getting a firm grip on the underlying mechanics, the why behind how prices change.
That's exactly right. Our mission with this deep dive is to cut through the noise and, the confusion surrounding the core principles of order flow.
Yeah.
It doesn't matter if you're brand new to trading or if you've been using order flow tools, but feel like you're just mechanically following signals without truly understanding what they mean.
Right, like clicking buttons without knowing why.
Precisely. Maybe you're comfortable with cumulative delta, but find footprint charts bewildering. We want to clarify the fundamental mechanics of how price moves. Understanding this theory is key because it should make any order flow tool you decide to use down the road significantly more productive.
I love that framing. It's like learning order flow is less about memorizing where buttons are on a dashboard and more about understanding the engine itself.
Yeah.
It's definitely an unfolding story like reading a book because the market is constantly changing.
Yeah, it really is.
And let's be real, it's also like riding a bike. It takes practice, screen time, and falling a few times to really get the feel for it.
Right.
We're definitely not promising instant profitability just by listening to this, but we are laying the groundwork of fundamental understanding.
And a super critical point before we dive into the technical bits. We're going to talk about several different order flow tools today. Think of these as different lenses to view the same fundamental process.
Okay.
You absolutely do not need to use all of them. In fact, trying to juggle too many tools simultaneously is a classic trap that leads directly to analysis paralysis.
Oh yeah, I've been there. Information overload.
Totally. Our goal is to give you actionable concepts derived from the source material that you can take away and apply, potentially by focusing intensely on one or two tools that best suit your trading style and the market you trade. It's about understanding the underlying theory so you can make informed choices, not just blindly follow indicators.
Okay, let's really unpack this then. You've likely seen diagrams showing price approaching a potential support or resistance level. It might reverse perfectly on the level, fall short in reverse, poke through slightly in reverse, or just blow straight through it like it wasn't even there.
The classic scenarios.
Right. So if you have a predefined price level based on a chart pattern or market structure, we expect to trade maybe an ABCD pattern completion, a prior swing high, or a volume profile node. The big question is, how do you know when or even if that anticipated turn is actually happening?
Right. Traditionally, you might manage this with a wide stop loss, hoping the level holds, or by, scaling into the position, adding contracts as price tests the level.
Common approaches.
Both approaches have merit, absolutely. But order flow offers a different lens. It can help you identify if the turn you expect is happening right now at your defined level, or if the market is showing signs it intends to blow through.
So it's about that real-time confirmation.
Exactly. This capability can help you stay out of trades where your expected level fails immediately, which can lower your risk on individual trades, even if it means occasionally missing a quick turn that happens without giving a clear order flow signal. It's a trade-off, but one focused on protecting capital.
That's a powerful application, using it for timing at a specific location. Beyond the precise entry timing, the source also points out that order flow is incredibly effective for simply setting a directional bias.
Absolutely. It's a fundamental filter. If the order flow over a relevant period for your trading time frame is consistently showing a bullish bias, perhaps more aggressive buying coming in, or sellers fading, you only look for long trade setups.
Does it filter out the noise?
Pretty much. If it's showing a bearish bias, you focus exclusively on short opportunities. This might sound simple, but adhering to it can significantly reduce the number of counter-trend trades you take, which are, often lower probability.
And this leads us to another key application discussed, one highlighted as a personal trading element for the source of this information: the second entry or pullback trade.
Ah, yes. This is a big one.
Forget trying to catch the absolute high or low of a potential reversal for a moment. The approach here is to first wait for the market to make a move that indicates a reversal might be occurring.
Patience is key here.
Then you use order flow to confirm that this initial move was indeed a significant reversal, establishing a new bias. Then you wait for a pullback in the direction opposite to that confirmed new bias, and use order flow again to time your entry into the trend.
Yes, markets tend to stair-step. They make a move, pull back, consolidate, and then continue. Order flow often reveals hidden backstops during these pullbacks areas where liquidity, new limit orders, fill in to halt the counter-trend move.
Stuff you might not see on a normal chart.
Exactly. Stuff that might not be obvious on a standard price chart. We'll dig into how to spot these later.
Pure scalping is another area where order flow is indispensable. While not everyone is a pure scalper holding positions for seconds or minutes, every trade entry, even for a position trader, is a form of scalping initially.
Right. You need to get filled at a favorable price and have the market immediately go your way, at least initially.
Exactly.
For scalping, order flow is your lifeblood for execution. But, and this is important, even the most dedicated scalper still needs a sound methodology for identifying where the high probability trading opportunities are, their trade location.
Right. Location, location, location.
Order flow is not a substitute for knowing where you are in the bigger picture or the significant levels. It's about understanding what's happening at those locations you've already identified as important.
The source also makes an interesting point about trading tight-ranging markets. Markets like the the S&P 500 futures, spent a considerable amount of time ranging in 2013, for instance.
Oh, I remember that choppy stuff.
Right. In such environments, simply looking at historical price levels isn't enough. Reading order flow, particularly the intent side of it, the limit orders resting in the book, what traders are saying they're willing to do at specific prices becomes crucial, sometimes even more so than the actual executed trades at range extremes.
Why is that? Because at the very edge of a range, it always looks like the level is about to break.
Always feels like it's going to go.
Yeah. Limit orders appear and disappear, probes push into new territory. The static chart doesn't tell you the dynamic game being played with those passive orders. Watching the DOM, the depth of market in these situations, observing large orders appear and whether price hits them and stalls or pushes through, or, crucially, whether those orders get pulled, that gives you insights into potential traps and turns that a simple price chart can't.
So it's about seeing the manipulation games, too.
Well, yeah, or just the real-time dynamics. This really ties into tape reading, which is a fundamental component of order flow analysis, understanding what the market participants are doing right here, right now, as price interacts with a predefined level you're watching.
And you don't stop watching order flow after you enter a trade.
Absolutely not. No. Order flow is not just an entry tool. Once you're in a position, continue watching the flow to see if it supports your premise.
Is it still going your way?
Right. Is the side you're trading with still aggressive? Is the other side showing signs of stepping in against you? It can signal whether your trade is likely to work or if your initial premise might be wrong, giving you an early warning sign to potentially exit.
Okay, so we've touched on why you'd use order flow and what some of its benefits are. But let's get to the absolute core concept, the one that underpins everything we'll discuss today. Why does price actually move? This is where many traders get confused.
It's a common misconception, yeah. People often say, oh, there are more buyers than sellers. But that's not quite right in terms of sheer numbers.
Because every trade has a buyer and a seller.
Exactly. For every single contract bought, there is a contract sold. The market perfectly matches buyers and sellers on every trade. So if you think about it just as buyer versus seller numbers, analyzing the flow might seem pointless.
And it's not traditional supply and demand in the sense of a physical commodity becoming scarce. Futures contracts are financial instruments that are created and extinguished with each transaction.
Correct.
Is it more about aggressive buyers versus passive buyers, or patient sellers versus impatient sellers?
You're getting closer. Perhaps the best way to think about it is in terms of less patient traders executing market orders versus more patient traders placing limit orders. But the real key question, the one that truly unlocks order flow theory and clarifies why price doesn't just jump around erratically, why doesn't the ES futures contract, for example, instantly leap from, say, 1580 down to 1260?
Yeah, you don't see those massive random gaps unless something catastrophic happens. There must be something holding the price structure together.
Precisely. The answer, the fundamental principle that stops price from moving around wildly, is the consumption of liquidity.
Liquidity. Okay. That word is everywhere in trading. How should we understand it specifically in the context of order flow?
In this context, liquidity is the availability of the other side to trade with you at specific price levels.
Okay, the other side waiting.
Right. If you are a buyer using a market order, liquidity is the pool of sellers waiting with limit orders to sell to you at the best available price. If you are a seller using a market order, liquidity is the pool of buyers waiting with limit orders to buy from you. And this availability is represented by passive orders resting in the market.
So liquidity is essentially those limit orders, the bids, orders to buy at a specific price or lower, and offers, orders to sell at a specific price or higher that are sitting on the electronic exchange order book.
Exactly. You are either providing liquidity by placing a limit order away from the current price, basically saying, I'll trade if price gets to X, or you are taking liquidity by using a market order saying, I'll trade now at the best available price.
Aggressive versus passive.
That's it. Aggressive traders use market orders, while passive traders use limit orders.
Okay, so price moves when aggressive orders interact with those passive limit orders. How does that work mechanically?
Let's use the analogy from the source, which I think is brilliant. Imagine the market is a building with no stairs or elevator.
Okay, weird building, but I'm with you.
You can only move floors by breaking through the floors or ceilings. The floors in this building are the buy limit orders, the bids. They are below the current price.
Okay, the support.
Kind of like support, yeah. The ceilings are the sell limit orders, the offers or asks. They are above the current price, like resistance.
Right.
To move down to the floor below you, you have to break through the floor you're standing on. To move up, you have to break through the ceiling above you.
And breaking through means consuming those limit orders, hitting them.
Precisely. Market orders are the force that eats or consumes these limit orders. When aggressive sell market orders hit and fill against buy limit orders, they eat the floor. Price is pushed down to the next available floor.
Okay.
When aggressive buy market orders hit and fill against sell limit orders, eating the ceiling, price is pushed up to the next available ceiling.
So it's not just about more buyers than sellers overall, but about aggressive buyers consuming all the available passive sellers, the offers, or aggressive sellers consuming all the available passive buyers, the bids. That's the key driver.
That's the fundamental mechanism right there. Now, here's where the analogy gets even more insightful. After you've eaten through a floor and dropped down to the next level, is it easier to move down again immediately or back up?
Let's see. If the floor I just broke through is gone, that barrier to going down is removed temporarily anyway. But if I've dropped down, wait, the ceiling that was above me on the floor I just left is, well, it's not there anymore from my new perspective, is it?
Exactly. As the source puts it vividly, there's a bloody big hole in the ceiling. There's nothing immediately above you at the price level you just left. This creates a relative liquidity vacuum.
A vacuum.
As price moves aggressively in one direction, it leaves a void of passive limit orders behind it because those orders were either consumed or pulled by the traders who placed them.
Ah, I see. So if aggressive buyers push price up by eating offers, the ceilings, they leave a vacuum of buy limit orders, floors, below the current price.
Yep.
And if aggressive sellers push price down by eating bids, the floors, they leave a vacuum of sell limit orders, ceilings, above the current price.
You've got it. Moving up creates a vacuum beneath you. There were no pre-existing floors, no bids waiting above the previous price level to stop a pullback. Moving down creates a vacuum above you, no pre-existing ceilings, no offers, below the previous price level to stop a bounce.
So the market has to kind of rebuild.
Right. For price to hold at the new level or continue moving away from this vacuum, new limit orders need to be placed. The market needs to repair the vacuum by building new floors and ceilings.
And we see these floors and ceilings visualized on the depth of market, the DOM, right?
Right. Precisely. The DOM is the literal visualization of the bids, the floors, and offers, the ceilings, waiting at different price levels. Most platforms only show a limited number of levels, maybe 5 or 10, like NinjaTrader's basic view.
Yeah, not the whole book usually.
But the liquidity exists beyond those visible levels. What's critical to remember is that as price moves up, there are no floors, no bids resting above the current price ready to trade. As price moves down, there are no ceilings, no offers resting below the current price. Price always moves into areas where liquidity exists on the other side. Aggressive buying moves into waiting offers. Aggressive selling moves into waiting bids.
So spotting these liquidity vacuums where price might pull back, not because of strong opposing pressure, but simply because there's nothing behind the move to prevent it. That's a key observation. And this ties back into the idea of second entry trades.
Absolutely. Recognizing that a pullback might be happening because the market has temporarily run into a vacuum below it after an upward move, rather than hitting strong counterselling, is a crucial insight. It suggests the underlying aggressive move might still be valid, and the pullback is just price retracing into that vacuum until new liquidity is built or it finds the next layer of interest.
Okay, that makes sense.
We'll talk more about how order flow helps you see this. For now, remember the core mechanic. No ceilings below you as you move down, no floors above you as you move up. The vacuum is behind the move.
The source also mentions that you should expect to see the structure of the market reflected in the DOM at key levels. For instance, at an expected resistance level based on your chart analysis, you should see thicker ceilings, thicker offers, then floors, bids on the DOM, maybe 1.5 to 3 times the size.
Yeah, that's a good check.
At support, you'd see thicker bids stacked up.
That's a great reality check if your chart screams resistance. But the DOM at that price shows minimal offers compared to bids. It suggests other market participants might not view that level with the same significance you do. However, and this is crucial, thick levels don't guarantee price will hold. Limit orders can be pulled suddenly and rapidly.
Pulled. What does that mean in this context, like yanked away?
Exactly. It means the traders who place those large limit orders decide to remove them from the book before they get filled. This is a common market phenomenon, often associated with spoofing, placing large orders with no intent to trade, hoping to influence others, or simply genuine position adjustments by large players.
You see a big wall of orders, and then poof.
Right. If you see a huge stack of offers at a resistance level, and price is starting to push into it, but then those offers suddenly vanish, that thick ceiling you expected price to hit just disappeared. It removes the barrier to upward movement and can signal that the level is about to break. It's the pulling of orders, especially large ones, that often reveals intent or changes in market structure more powerfully than their initial placement.
That's a really important nuance. It's not just the static picture of the DOM, but how those orders are behaving dynamically, super dynamic.
Exactly. At any moment, the market essentially has two prices. The highest buy limit order, the inside bid, the highest floor price someone is willing to buy at, and the lowest sell limit order, the inside offer, the lowest ceiling price someone is willing to sell at, separated by the bid-offer spread.
The spread, yeah.
Aggressive market orders bridge this gap by consuming the waiting limit orders.
To summarize the core concept then, price moves because market orders consume limit orders. When that happens, liquidity is consumed at a price level, and price has to move to the next level where passive orders are waiting on the other side. This consumption leaves liquidity vacuums behind the move. All order flow analysis is essentially finding different ways to visualize and interpret this fundamental process and the vacuums and the filling in of new liquidity that follows. Observing these vacuums, where price pulls back due to lack of opposing liquidity and how new liquidity builds behind the move, is like looking in the rearview mirror to see the support lines forming as price stair-steps.
That's an excellent summary. That really captures it. Now, how do we actually apply this understanding? Let's look at how the liquidity consumption model helps us interpret common market behavior and, crucially, how to identify reversals.
Right. The source uses this model to explain patterns we see on charts all the time. For instance, the difference between a sharp, rapid spike in price versus a slow, grinding move.
Correct. A rapid spike up is often perceived as immense bullish strength. And in a sense, it's aggressive buyers quickly consuming a lot of passive offers.
Less powerful.
It does. But our liquidity model tells us it also creates a larger and more significant liquidity vacuum behind it compared to a slower move.
That vacuum again.
This suggests that while the initial move is powerful, a deeper retracement might be necessary later to fill that larger void before the trend can confidently continue. It's like punching a huge hole in the ceiling. It takes more time and effort to patch it up from below.
So a fast move, while exciting, might actually signal a greater potential for a significant pullback later, precisely because it was so fast and left a big vacuum. That's interesting.
Precisely. Conversely, a slow, grinding move up is often frustrating for traders and is frequently interpreted as, oh, the buyers aren't aggressive, it's just grinding.
Yeah, it feels like it's running out of steam.
But based on liquidity consumption, this grinding action is actually a sign of underlying strength and healthy price acceptance at successively higher levels. Why? Because as price moves up slowly, those small vacuums created by the aggressive buyers are being filled in by new limit orders, new floors, new bids are being built often in real time.
So it's building support as it goes.
Exactly. The market is consolidating and accepting price at each step. While grinding moves are harder to jump into with pullbacks, knowing they signify strength can give you confidence to look for entries even without a deep retracement.
That's counterintuitive, but makes sense when you think about the liquidity behind it. What about retracements and pullbacks themselves? How does order flow help us see what's happening there?
Pullbacks in an established trend, like a dip within an uptrend, can often be identified by a lack of participation in the counter-trend move.
Okay, lack of participation.
If the market is pulling back because it just ran up too fast into a vacuum, or maybe just normal profit taking, you won't see significant volume or aggressive delta that's buy market orders versus sell market orders confirming strong selling pressure in that pullback. The selling will appear weak relative to the buying that drove the main move.
So in an uptrend, if price pulls back, I should see some selling, obviously, because people who bought lower are taking profit, or late buyers are getting scared out.
Sure, there will be selling.
But the order flow during that pullback should look relatively weak compared to the flow that drove the price up, like less aggressive.
Exactly. The amount of selling should be noticeably less significant, lower volume per tick, weaker negative delta per price swing. And as we discussed, markets stair-step because it takes time for new liquidity, new floors and ceilings to appear and solidify behind a move.
Right, the rebuilding.
Pullbacks are also natural pauses, where intraday traders who entered earlier positions might need to unwind, turning temporary buyers into future sellers who need to offload their positions, prompting the market to dip slightly to find new buyers. But if the underlying trend is strong, order flow will show that the selling pressure is limited.
This leads us directly to distinguishing a major reversal that might signal a new overall bias from a minor pullback that's just an entry opportunity in the existing trend. This seems like a key skill.
This is where applying the theory becomes crucial. Based on the liquidity consumption model, the source identifies only 3 essential elements that can cause a reversal.
Only 3, okay.
Every reversal, whether it's a tiny blip or a major market turn, will feature at least one of these, and often more. Without them, a reversal simply cannot happen. Let's use a long to short reversal example: price moving up, hitting a level, and then reversing down.
Okay, lay out the 3 elements. What's the first?
Element 1, absorption. This happens when aggressive buying continues. Buy market orders keep hitting the offers, trying to push price higher, but the price doesn't move through the ceiling, the offers.
Like a wall.
Exactly. Why? Because the ceiling, the offers, is either initially incredibly thick, or as the buying consumes the existing offers, new sell limit orders are quickly added right behind them, replacing the consumed liquidity. This rapid replenishment of passive orders as they are hit is often referred to as an iceberg order because you're only seeing the tip of the volume on the DOM.
So it looks like buyers are doing everything they can to push price up, hitting every offer in sight, but sellers are just soaking it all up, holding the line like a sponge.
Precisely. Sellers are actively stepping in and absorbing all that aggressive buying pressure. Eventually, the buyers give up or run out of funds and the price fails to move higher. Absorption is often one of the easier reversal elements to spot in order flow tools, particularly the DOM, because you can often see the significant volume hitting a price level without price budging.
You can visually see the battle.
Yeah. On thicker markets like ES, this can sometimes play out over several minutes at a key price. The source notes you might try to join the trade right at the absorbed price, shorting the offer, but on faster markets like ES, you often won't get filled unless you have very low latency or the market is temporarily slow. It's more reliable as a signal that a turn might be coming.
Got it. Absorption. Aggressive orders hitting a wall of passive orders that doesn't break.
Yeah.
What's the second element?
Element 2. Buyers fading away. This occurs when the market reaches a potential high, and there's simply a noticeable lack of willingness among aggressive traders to buy at that price level anymore.
It loses interest.
Kind of. It can manifest gradually, where the size of market buy orders hitting offers gets smaller and smaller with each tick up. Maybe you see 1,000 contracts trade at 4,500, then 600 at 4,500.25, 300 at 4,500.50, and then only tiny 50 lot trades at 4,500.75.
Okay, dwindling size.
Or it can be sudden. Market ticks up to a new high price, and suddenly barely any or zero trades execute at that level. Crickets.
So the enthusiasm or aggression on the buying side just disappears at the potential high.
Exactly. A clear drop-off in volume or the size of trades printing at the potential reversal level. On very thick markets like Treasury futures, this price level might only get hit once with tiny volume before price retreats. On ES, it might revisit the level a couple of times, printing minimal volume each time.
And you need to see this at key levels, right? Not just anywhere.
Absolutely. This fading needs to be watched for specifically at key price levels you've already identified as potential turning points, not randomly in the middle of nowhere. There's a time element here too. It takes a moment for buyers to realize that other traders aren't stepping in with them at this high price, which can then trigger some of those earlier buyers to start unwinding their positions, adding to the selling pressure.
So don't jump the gun.
Right. The source advises against immediately shorting just because volume fades. Wait for confirmation, because sometimes price will just consolidate and then push through.
Okay, so we have absorption, hitting a wall, and fading, running out of gas. What's the third element?
Element 3, sellers coming in force. This is often the most dynamic element. The market reaches a level, and suddenly, without much gradual warning, a wave of large, aggressive sell market orders appears, hitting bids and driving price down.
The cavalry arrives for the other side.
Pretty much. This can happen after absorption or fading has weakened the buyers, but it can also appear quite suddenly. You'll see significantly higher volume on the sell side, sell market orders consuming bids, compared to the buy side, buy market orders consuming offers. Over a short period, the source suggests looking for maybe 1.5 to 3 times the size, an irregular or excessive amount of selling.
This is like the other side suddenly fighting back hard and winning, decisively pushing down.
Yes, they are aggressively taking liquidity on the bid side, pushing price through the floors. This element is sometimes the hardest to spot in time if you're using it as an entry signal, because by the time it's unequivocally clear on order flow tools that this aggressive selling is happening with force, the market might have already moved 2 or 3 ticks down from the high.
So you might miss the absolute top.
Often, yes. This is often where traders pay for confirmation. They enter at a slightly worse price than the absolute high, but they have higher certainty that the reversal is actually underway.
And this element is incredibly useful for confirming a trade you might have already entered based on one of the other elements. If you shorted a resistance level because you saw absorption or fading, you then watch for sellers coming in force to confirm your position is likely going to work.
Absolutely. This reinforces the point. Don't stop watching order flow after you enter. Is the aggressive selling continuing to support your short? Or is buying starting to appear against you? And remember, these 3 elements are not mutually exclusive. You will very often see more than one of them present in a reversal sequence.
Like a combo move.
Yeah. Absorption might weaken buyers, leading to fading, which then gives sellers the confidence to step in force. But every reversal, large or small, will exhibit at least one of these 3 fundamental liquidity dynamics.
Okay, so we know the 3 ways a reversal can occur based on liquidity dynamics. How do we use this to solve that practical problem of distinguishing a major reversal, which sets our bias, from a minor pullback, which is an entry opportunity in the existing bias direction?
Good question. The source provides a set of criteria to help you make that judgment. To determine if that last counter trend move you saw was a major reversal that signals a new bias, rather than just a shallow pullback in the old trend, you ask?
Oh, checklist time.
1. Did that move occur in an area you already expected a major reversal? This takes us back to the importance of having your trade location identified, using charts or other analysis before you even look at the detailed order flow.
Location first.
Always. 2. Was the accompanying delta or footprint analysis significant? Did the net market order activity strongly favor one side? 3. Was the accompanying volume significant? Was there a large amount of total trading activity involved in that move?
High participation.
Right. And 4. Was the number of ticks or the swing size significant compared to the typical size of previous pullbacks within the existing trend? Was it just way bigger than normal?
So let's say I'm in a strong downtrend and price makes bounce up. I look at these factors. Did the bounce start right at a major support level I had marked? Was the cumulative delta of that bounce strongly positive? Maybe indicating, like the source said, 10,000 plus more buy market orders than sell market orders on ES?
Yeah, that kind of magnitude.
Was the total volume traded during that bounce really high? And was the move itself, say, 20 ticks, while the previous little pullbacks in the downtrend were only 5-7 ticks?
Exactly. If you can answer yes to multiple of these questions, it strongly suggests that move was a major reversal. It wasn't just a shallow dip quickly bought up. It was a significant shift in market participation and order flow dynamics from a key level.
Okay, so that signals a potential bias shift.
This confirmed major reversal is what you then use to set your new directional bias. If that move up meets these criteria, you now have an upward bias.
And this is where the second entry strategy comes into play.
Precisely. Once you have that new upward bias established and confirmed by a significant reversal move, you don't necessarily jump into the market immediately. You wait.
Patience again.
You wait for the market to drop back down. This is the pullback. The critical insight here is that the order flow accompanying this pullback should look weak. It should show smaller cumulative delta shifts, lower total volume, and a smaller price swing size relative to the powerful move that just set your new upward bias.
So during the pullback, I'm looking for signs that the counter trend selling is less aggressive, less convincing, than the buying that established the new upward move. Like it's half-hearted.
That's right. You're watching for that pullback to occur into the relative liquidity vacuum left behind by the initial strong move. And you wait for the floor to form below you during this pullback, watching for new bids appearing on the DOM or absorption dynamics on other tools, indicating liquidity is filling in to support price at a higher level.
Watching for that repair job.
Right. Then you look for one of those three reversal elements absorption. Sellers hitting a bid that holds, sellers fighting away, volume dries up at the low of the pullback, or buyers jumping in, sudden aggressive buying with size to appear at the low of this weak pullback. That is your signal to enter the second entry trade, trading in the direction of the newly established bias.
It sounds like you're waiting for the market to show its hand, confirm the new direction, then wait for a less contested area to enter. A calmer spot.
Exactly. The source explains why this is a powerful strategy. While second entries typically offer less potential profit per contract than trying to nail the absolute high or low.
Yeah, you give up a bit of the move.
You do. But they are traded in significantly less crowded areas. Major highs and lows are magnets for all types of traders, trend followers trying to break out, faders trying to pick the top, hedgers adjusting positions. This makes those extremes prime real estate for market manipulation and choppy trading as large players try to trap retail traders.
The stop runs and fakeouts.
Exactly. Minor reversal points, like the low of a pullback within a confirmed new trend, have fewer people focused on them, which can make the order flow signals cleaner and easier to read. If you find yourself consistently trying to fade extremes and getting run over...
We've all been there.
Right. Using the major reversal to set bias and then trading the subsequent confirmed pullback can be a much more robust and less stressful approach.
That shift in perspective is incredibly valuable. It's not about predicting the turn, but reacting to its confirmation and joining the established momentum on a dip. Okay, we've covered the core theory and its application to market behavior and entry strategies. Now let's look at how specific order flow tools help us actually see this theory. The liquidity consumption, the vacuums, the three elements in action. As you said, these are just different windows into the same fundamental process.
Okay, let's start with cumulative delta.
What exactly is cumulative delta showing us, tying back to our core theory?
Cumulative delta is a running total of buy market orders minus sell market orders over a specified period, often the start of the trading session, or maybe a specific swing. If our theory says price moves when market orders eat limit orders...
The consumption.
Right. Cumulative delta is essentially tracking the net effect of that eating. A positive delta means more aggressive buying, eating offers happen than aggressive selling, eating bids in that period. A negative delta means the reverse. It's the net aggression.
How do the three reversal elements show up on cumulative delta?
Okay, absorption. You can see it as cumulative delta moving up, meaning more net aggressive buying, while price stays relatively flat at a level.
Delta up, price flat.
Right. This implies that even though buyers are hitting the offers, price isn't moving because there's a wall of passive sellers absorbing that buying pressure. However, the source notes that cumulative delta is often too zoomed out for very precise short-term absorption signals.
Why is that?
By the time a large amount of volume has been absorbed and the delta buildup is obvious on the cumulative line, price might be on the verge of breaking through anyway, potentially trapping those absorbed sellers. It's a bit lagging for that specific element.
Okay. What about buyers fading?
This is less easily discernible on cumulative delta directly because it's a running total. You might see the rate of delta increase slow down as price approaches a high, but it's not as clear as seeing individual trade sizes or volumes at specific price levels dried up. It's more subtle.
Harder to spot clearly, and sellers coming in force.
This is visible as cumulative delta turning sharply negative. But again, similar to absorption, by the time that aggressive selling has accumulated enough to cause a significant obvious drop in the cumulative delta line, the market might have already moved 2 or 3 ticks down.
So cumulative delta isn't the best tool for spotting those elements in real time for a scalping entry at the exact turn. It's more of a bigger picture confirmation tool.
Correct. The source's primary use case for cumulative delta is different. Setting your directional bias and, crucially, identifying those weak pullbacks or liquidity vacuums within an established trend. You look for the cumulative delta line to not shift significantly during a counter-trend price move.
The flat delta during a pullback.
Exactly. Indicating that the pullback lacks aggressive participation and is likely just price retracing into a vacuum.
You provided a chart example using ES 900 tick swings to show this. Can you walk us through that?
Yes. Yes, that chart visualized price swings, coloring them green or red based on which side had the most volume in that swing, with the cumulative delta line below. It showed, for instance, a swing down of 12 ticks with 48,000 contracts traded and significant negative delta. Big move, big delta.
Okay.
The subsequent 5-tick move up had only 4,000 contracts, and the cumulative delta barely budged.
Flatlined.
Tiny volume, tiny delta change. This highlights the theoretical concept. The small move up was weak because it lacked participation, low volume, and aggressive buying, flat delta, confirming it was a pullback into a vacuum, not a reversal. The source suggests on ES, a delta shift of maybe 10,000 contracts or more within a move can be a threshold for a confirmed reversal to potentially set bias, whereas a pullback within that bias shows minimal delta change.
The example also showed instances where price action alone wasn't clear, like a move up that fell short of a prior high by 1 point.
Right, looked like a potential failure on the chart.
But the accompanying order flow, huge volume, 31,000 contracts, large delta shift, 15,000 plus white swing, a big 31-tick swing indicated it was a significant move that set an upward bias, even if the chart structure didn't show a clean pullback immediately afterward for second entry.
Exactly. And another example highlighted a failed high followed by a big 19-tick push down with 70,000 volume, huge selling pressure.
Yeah.
The subsequent pullback had minimal delta shift, signaling weakness in the countermove and confirming the ongoing bearish bias, leading to a continuation down. The example also showed a low where price bounced, but the cumulative delta initially didn't support a strong reversal read. It was messy.
Took time to confirm.
Yeah, until a later move up showed a clear delta shift of over 15,000 contracts, confirming that the bottom had indeed formed.
So cumulative delta is great for analyzing completed moves, especially historically, because it looks the same in hindsight as it does in real time, which isn't true for all tools. But it's less useful for predictive power on its own and can be tricky in thin markets like crude oil where market limit order dynamics differ, sometimes causing delta to diverge misleadingly from price.
That's a fair summary. Moving on, let's look at footprint charts.
This is the tool that shows trades at the bid next to trades at the offer within each price bar or range bar, right? So the paired numbers, like a volume profile for each bar.
Exactly. It's a more granular view. Unlike cumulative delta, which gives you the net difference summed up, footprint charts show you the individual battles at each price level within a bar. You see buy volume on the right, often colored green, and sell volume on the left, often colored red, for each price increment. You mentally calculate the delta for each price, or the bar delta is usually shown at the bottom. It's a zoomed-in perspective.
How do the three reversal elements look on a footprint chart?
Okay, absorption. This is quite clear on a footprint. You see large contract numbers on one side, trading aggressively into a specific price level at the extreme of a bar or swing, but the price doesn't move through that level.
High volume, no price change at the edge.
Right. For our long to short reversal example, you'd see large numbers on the right side, the buy volume, often green, at the very top price level of a bar, indicating aggressive buyers hitting offers, but the bar doesn't tick higher. The source's example showed numbers like 5,000 and nearly 8,000 contracts, trading on the offer side at 42.75, with price stalling there.
Big numbers hitting a wall.
Important caveats. You will still see volume on the other side because trading is two-sided, and volume from subsequent price moves within the same bar can add to the numbers shown. Looking at where the bar closes relative to the absorption level is key, as indicated by white boxes in the source's example chart.
Got it. What about buyers fading on the footprint?
On a footprint, you'd see very low or zero contract numbers printing at a price level, especially at the potential top of a bar or swing. This is the direct visualization of traders not wanting to buy at that price. The example showed tiny numbers like 44,593 contracts at highs, signifying a lack of buyer interest.
Just trails off to nothing.
Yeah. Price might revisit the level and you'll see minimal volume printed each time, confirming the fade.
And sellers coming in force.
As price moves down, you see significantly more volume on the sell side, the left numbers red, than the buy side, the right numbers green, within the bars roughly 1.5 to 3 times the size. The delta for that bar would be noticeably negative.
Clear imbalance to the downside.
Exactly. The example showed bearish delta and larger numbers on the sell side appearing after buyers faded at the high. You could use this to confirm a short entered based on absorption or fading, or potentially as a less aggressive entry signal, waiting for the price to break and show this aggressive selling confirmation.
The source suggests using footprint charts with range charts, or point and figure charts, not time-based charts, for better historical analysis. Why is that distinction important?
On a standard time-based chart, like a 5-minute bar, price can go up and down multiple times within that 5 minutes. The footprint for that single bar will combine all that up and down volume at each price level.
It gets messy, all mixed together.
Right. This can make it difficult to clearly see the sequence of events or analyze historical patterns of absorption or fading within specific upward or downward movements. Range charts, or point and figure charts, however, create new bars based on a specific price movement. Like a new 5 range bar is created only after price moves 5 ticks.
So it separates the moves cleanly.
Exactly. This separates the clear upward and downward movements into distinct bars, providing a much cleaner and more readable historical footprint profile of buying and selling activity within those specific moves. Examples like the ES5 range or crude 10 range were mentioned.
The example chart with the range bars and footprint showed how you could have potentially traded a range top. Observing volume disappear, the fading, then an attempted hold by bids that failed, high volume on the left but price broke down anyway, followed by bearish delta and price breaking lower, sellers coming in force.
And that example emphasized the importance of trade location even with footprint confirmation. Seeing aggressive selling on the footprint is valuable, but if it's happening in the middle of a wide trading range with no defined support resistance nearby, shorting there carries much higher risk than waiting for that signal at the range extreme. Location matters.
So footprint charts offer a detailed look at volume at each price level, giving you a sense of the micro battles. They're often seen as easier to read in real time than historically on standard charts, which is a key characteristic.
Next up, the order book, also known as the depth of market, or DOM.
This is the one that shows the waiting orders, the floors and ceilings, the intent, right? What traders say they want to do.
Exactly. This is its key distinction from delta and footprint, which focus on executed trades, the action. The DOM shows the passive liquidity directly. However, the source is very clear. For the DOM to be a useful order flow tool, not just an entry tool.
Needs more than just the waiting orders.
Right. It must also show executed trades at each price level, not just the quantity of limit orders waiting. Platforms like Jigsaw, XTrader, and CQG were mentioned as having this capability. You need to see what actually traded against those limit orders.
The DOM gets a bad rap sometimes because it's known to be heavily manipulated with spoofing and stacking, placing large limit orders that are intended to be pulled before they are filled, just to influence price or trick other traders. Fake walls.
The source acknowledges this manipulation happens, absolutely, but argues it doesn't render the DOM useless. Spoofers engage in this game precisely because it works and is profitable for them. And crucially, they risk getting filled if the market moves faster than they anticipate.
So you can watch the game.
Yeah, you can learn to observe this manipulation game. Watching for when large orders are pulled can be just as important, maybe even more important, than seeing them placed. A large order placed is intent. A large order pulled right as price approaches suggests that intent was false or has changed.
Okay, what does a typical good DOM view look like? One that includes executed trades.
You'll have columns showing the quantity of bids, the floors, often blue, and offers, the ceilings, often red, waiting at each price level. The critical part is the central column, which displays the volume of executed trades that have occurred at each price level in real time.
The actual transactions.
Yes. Some advanced DOMs might even show visualizations of pulling and stacking activity. Volume profile might be shown alongside to provide location context, showing historical volume distribution on the same price scale. The DOM is primarily a right here, right now, ultra short-term tool.
Very immediate.
Extremely. It's best for refining an entry at a level or getting immediate feedback on whether your trade is going your way. It provides very little historical context compared to charts.
How do the 3 reversal elements appear on the DOM, specifically focusing on the executed trades column?
Okay, absorption. This is the easiest element to spot vividly on a DOM with executed trades. You see a very large volume of executed trades hitting into a specific price level, particularly on one side, like buy market orders hitting an offer at the top of a potential reversal, without the price moving through that level.
Lots of trades, no progress.
Exactly. You'll see high numbers rapidly appearing in the executed trades column at that price. The source gave an example threshold of seeing significantly more than usual volume hit, perhaps 3,000 contracts on ES at a single level, without price breaking through. You might see high numbers in the orders adding column on the passive side alongside the executed trades, indicating new limit orders are being added as they are consumed the iceberg effect again.
Got it. Buyers fading on the DOM.
On the DOM, as price reaches a potential high, you see very low or even zero contracts executing at that price level in the executed trades column. Price might attempt to tick up to that level again, but you'll see only minimal volume print. There's a noticeable pause or lack of activity at that extreme as traders realize nobody else is joining them at that price, which can precede traders trapped at that high unwinding position.
The energy just vanishes at the top.
Pretty much. Other side jumps in, sellers coming in. The market reaches a level, and you see a sudden rush of large trade sizes hitting the opposite side's waiting limit orders, visible as large, rapid prints in the executed trades column.
Big orders smashing through.
Yes. For example, if price is trying to reverse down, you'd see significant volume hitting the bids, red prints in the central column associated with sell market orders, driving price down through the floors. You might see executed trades of 500, 1,300, 1,200 contracts appearing quickly, pushing price lower. Importantly, this requires price progression. If you see lots of large sell trades executing, but price isn't moving down,
Then they're being absorbed on the other side.
exactly. It means new bids are absorbing that selling the floors are holding, and it's dangerous to enter short. Need to see price move with the volume.
And the manipulation aspect, seeing those huge stacks appear after price has already moved several ticks. What about that?
Yes, the source calls this icing on the icing. Seeing large limit orders like 3,000, 3,000, 3,000 bids appear suddenly below price after it has already rallied 5 or 6 ticks is a clear manipulative tactic.
What are they trying to do?
These are often spoofers trying to lure other traders in to buy above their bids so they can unload their long positions. They create a false sense of security below. If you see those orders get pulled, it's a huge red flag because the artificial support is gone and price is highly likely to collapse.
So watch for the pull.
Be aware of this game, but the source prefers not to try and join the manipulators, instead using it as a warning signal if they are on the wrong side of the potential move.
It sounds like you can get a lot of value from the DOM just by focusing on the executed trades and the dynamic behavior of limit orders, adding pulling, even without getting too bogged down in the static quantity displayed.
Absolutely. Focusing on the action in the executed trades column and observing the dynamic changes in limit order levels, especially large ones, is often sufficient. Alternative DOM visualizations like meters showing the imbalance of trades hitting the bid versus offer, or indicators showing the rate of change in depth, are also ultra-short-term tools built on the same principles.
Finally, time and sales, or tape reading, the raw data stream.
This is the most basic raw view of order flow. It shows individual trades as they occurred, the price, the size, and the time. It gives you a feel for the market's pace and rhythm.
This feels like the ultimate right here, right now tool.
Yeah.
Even more than the DOM.
It is, in a way, like the DOM, it's ultra-short-term. It's not for looking back at historical structure or patterns over hours. Its value is in seeing the granularity of trading activity. Seeing 5 individual trades of 200 contracts print at a price gives you different context than seeing 500 trades of 2 contracts. Even if the total volume is the same, the size of individual prints matters.
The source mentioned a CME change in 2009 that affected how large orders appeared on the tape, made it harder to read.
Yes. Before 2009, if a trader placed a 1,000 lot order and it got filled against multiple smaller limit orders, it would often appear as a single 1,000 lot print on the tape. Big print, big order.
Clear signal.
After the change, that same 1,000 lot order filled against many small orders would appear as many small prints, like dozens of 5-lot prints. This made the raw tape much harder to read for large order activity.
So how do you see the big orders now?
Modern aggregated time and sales tools, like those that attempt to reverse engineer this change, are necessary to get a better estimate of the original size of aggressive orders. Jigsaw's tool was mentioned as being estimated around 95% accurate for the CME modification. They try to piece the small prints back together.
How do we read time and sales to spot those 3 reversal elements, given it's just a stream of prints? Seems overwhelming.
You need to focus on the price and contract size, often filtering out unnecessary decimal places or even the time to reduce visual noise. Simplify the view. The pace of the prints is crucial. A rapid fire hose of prints is different from slow, infrequent prints.
Okay, absorption on the tape.
You see a rapid stream of prints, predominantly on one side, like lots of green prints indicating buy market orders occurring at the same price level without the price ticking up.
Prints keep coming. Price stuck.
Exactly. This shows aggressive buying hitting supply that's not yielding. You'll still see some prints of the other color, but the dominance of one color at a stable price is the key signal.
Bias fading. How does that look?
In a move, say price moving up with lots of green prints, the aggressive prints, the green ones, suddenly stop coming at the highest prices reached. There's a clear maximum price where the green prints occurred, and only red prints, selling, appear below that level. Those who bought the highs are now potentially trapped as the aggressive buying fades away.
The buying just stops at the peak, and sellers coming in force.
As price moves up, mostly green prints, you see a sudden surge of red prints, and the price starts moving down as a direct result. You need to see price progression downwards with the red prints. If you see lots of red prints, but the price doesn't move down.
Means they're hitting bibs that are holding. Absorption again.
Exactly. It means those sell market orders are being absorbed by bids, the floors are holding, and entering short based on the prints alone would be dangerous.
So time and sales provides the least historical context of any tool. It's very pace-focused, and not everyone finds it easy to process in real time. It definitely requires practice.
Definitely. However, the source gives a powerful tip, especially for beginners. Filter time and sales to show only large trades, maybe 100 contracts or more on ES.
Filter out the small stuff.
Yeah. In an uptrend, you watch for large green prints driving price up. Then you observe large green prints appearing, but no tick up in price. Price stalls despite the big buys. This is followed by a pause, maybe a minute or two, where those large prints aren't moving the market.
The big buyers are stuck.
That's the implication. This suggests those large buyers might be trapped at the high. The other side, the sellers, then feels emboldened to come in and push price down. Watching for this specific pattern of large print stalling price followed by a pause can be a powerful signal at market extremes or key levels.
That specific pattern sounds like a tangible thing to watch for, like a setup.
It is. Time and sales is ultra short-term, focused on pace and granularity, and isn't for everyone, but it's powerful for spotting potential traps signaled by large order activity at critical price points.
Okay. To bring this full circle and wrap things up, let's revisit the core message. Understanding order flow, boiled down to its essence, is about the theory of liquidity consumption.
Back to the beginning.
Right. It's aggressive market orders relentlessly eating, through passive limit orders, the floors and ceilings, and the resulting liquidity vacuums and subsequent replenishment. This single fundamental theory is the engine driving price movement, and all the order flow tools we've discussed today are simply different ways to visualize and interpret that engine in action.
It's a highly discretionary tool, like reading the constantly unfolding story of market participants' intentions and actions. It absolutely requires practice and screen time to develop the feel for it and recognize the patterns playing out, but the patterns are based on logical human behavior in the market.
And it's crucial to remember that order flow is often described as the icing on the cake.
Love that analogy.
The cake is your underlying methodology for identifying a good trade location, your chart analysis, market structure understanding, volume profile analysis, or whatever you use to find high probability price levels. Order flow is the icing, the vital confirmation tool that tells you what the market is actually doing right now at that location you've identified. Is the reversal you expect happening? Is the trend likely to continue through this level?
Scalpers rely heavily on order flow for their split-second decisions, but position traders also use it effectively for confirmation, better entries, and managing trades after they're on. This discussion was an introduction to the concepts. More detailed applications, like using volume profile or market profile, which can be part of the cake, defining locations, or delving deeper into auction market theory, build upon this foundational understanding of liquidity consumption.
And while awareness of manipulation tactics like iceberging and spoofing is important, the DOM especially shows this game, the source suggests the focus isn't necessarily on trying to trade with the manipulators.
Probably not wise for most people.
But rather using their actions as a signal to potentially exit a trade quickly if you see they're trying to trap traders on your side. Use it defensively.
Order flow, particularly the DOM, is the battlefield where the game is played out in real time. Understanding why that game is played because it pays off for those who do it effectively underscores the value of being able to read it, even if you're just observing the action to protect yourself or confirm your own trades.
So let's leave you with a thought to consider after this deep dive. Given that the core mechanism is aggressive orders consuming passive liquidity, and the tools just show this from different angles, how can you start observing the market today? Perhaps even without loading up a complex new order flow chart.
Yeah, how can you apply this right away?
Can you start to visualize price, approaching a key level. And instead of just seeing a line on a chart, try to imagine the aggressive buyers hitting the offers, the aggressive sellers hitting the bids, and the passive limit orders waiting there like floors and ceilings. How does watching that fundamental interaction, even conceptually, change your perception of the market's intentions at this moment?
It's about building a new intuition, really. Start simple. Focus on observing the interaction of flow and liquidity at levels you already watch. Don't try to use every tool at once. Pick one or two that resonate and focus on how they illustrate that core principle of liquidity consumption playing out in real time. Practice and observation are your best guides here.
That sounds like excellent advice. Thank you for joining us for this deep dive into order flow theory.
My pleasure. Always good to talk shop. Until next time.